Hello, everyone. Welcome to today's session. Sorry, I had a little bit of a microphone issue there, so I had to reboot a couple of times, but I think I am back in business. If you'll just let me know if you can hear me and see my screen okay. And then we'll jump right into it here. Market conditions, still bullish in this bull market. Running into some resistance right here in S&P 500. We'll look at a couple of those charts here as well. We are seeing the momentum indicator. We're back in this bullish zone. And we also have breadth indicator, which is working its way back towards this trending zone. It had fallen off pretty aggressively right here. Okay, perfect. Thanks, Kirk. And is finding some support right here, but starting to work its way back up again. We'll see if that is going to be enough to continue to push the market out. As we've discussed before, market as S&P 500 and NASDAQ are really being controlled by really by the Mag 7 or just large tech for the most part is what's moving the market right now, and that's it. There's really not a whole lot else that's moving the market. And we have biotech and we have a lot of medical and medical device and stocks like that are also working. But not real broad-based participation. We are seeing sentiment, which is still in this upper complacency range. So not a lot of fear. Really haven't seen that either. A couple of days of light selling, but really nothing aggressive. We're seeing buy-sell ratio, which is at 1.84. Really volatile, really choppy, and not surprising where we're at in relation to the trend, where we're at in relation to the time of year, where we're at in relation to really just everything. We're at the upper end of this range. We're at all-time highs, and we have interest rates and inflation that are still high. So, market conditions, what's going to come this year? There's, I'm starting to read more and more really doomsday, really, like scary type economic type stuff as well. My experience is, I like to know what discussions are happening on both sides, really bearish, really bullish, and the truth tends to be somewhere in the middle. And ultimately, the market conditions, the market will start to reveal itself. The market will start to reveal the truth. We don't have to know anything that is unknowable or not known. We just simply have to realize that where we're at in this trend is probably unsustainable. The fact that we are at the upper end of this current trend here on the 1-year time frame. Not saying that we will get or could get one of these retracements that look like this last summer, but we certainly could get a sideways consolidation. Even this zone right here has been holding up. We had some support here. This is SPY, S&P 500. And there's a couple different levels, but on this 1-year time frame, we could go all the way back to this support area. This is really the breakout point of really the real long-term trend on S&P 500. This broke out to new highs. So the bulk of this has been new highs and finding some support. So we really could retrace quite a bit and still be in a pretty sustainable, a pretty good upward trend as a whole, where we could pull back into this range. So we'll see if and when that happens. It's going to happen. It's just a matter of, do we get one more move up and then get a retracement back down, or do we start to retrace here? Do we kind of get a consolidation? It's always harder. It's always hard to pick market tops and bottoms, and we don't necessarily have to. We don't necessarily want to pick the entire top or bottom, but what we want to start to do is we want to start recognizing some clues. And what that means for us is at the portfolio level. Okay, and I'll talk about that again as we get into this today. Let's market sentiment here. We've got some divergence happening between the sentiment, this high, and here we're S&P 500. If I go back to that chart right here, we now have, you can see that divergence was starting to happen right around here, and it's continuing to move higher. So we're getting that divergence, we're getting that topping feel, we're at all-time highs, we're seeing not broad-based participation. Those are just clues in how do we want to allocate our capital. The directional alerts page says bullish in a bull market. This means traders, investors should consider trading bullish, buying, going long stocks, ETFs, call options. that's a bullish strategy. What it doesn't say here is how much and what percentage of your assets and how big of a position should you be taking, and all of those things. That's where this information starts to become more valuable, is to say, are we at the beginning of the trend? Are we at the middle of the trend? Or at the end of the trend? Well, we know that we're not at the beginning of the trend. We know that we had this reversal. Just kind of a little review here. We had COVID. This was the COVID low. This was the rally after COVID. This was the retracement that we had in 2022, 2023, or at least the end of 22, the beginning of 23, and then most of 23 has been this overall uptrend. Now beginning into 24, the tail end of this uptrend. So we're now into this indicator also reaching new highs, and this is as high as it has got. I think I saw it get up to 21 or 22, and we're sitting right around 17. So we could get a little bit more, momentum to the upside. But what are the probabilities when you start to look at a stock chart that looks like this, and it's gone straight up, and we're looking at every other time that it's gone straight up? Well, are we trying to fool ourselves that it's not going to retrace, or are we worried that we're going to miss out on the upside? Or are we worried that we're going to be late to the game or early to the sell-off? Right? Some of those mental games are really what ends up hurting us the most in asset allocation, and then ultimately deciding which stocks to buy, how many to buy, and how to be able to manage that. So one of the ways to be able to do that, let me talk about a couple other market conditions, and then we'll move along here. TLT, let's look at bonds and oil, because bonds, we've had this issue with bonds. Remember, what's happening with bonds and the Federal Reserve is, as they're dealing with interest rates, and when interest rates are going higher, bonds are going lower. So right here during this run up that we had, interest rates were dropping, and this was all in anticipation of the Fed starting to lower interest rates. They haven't done it. They probably aren't going to do it. Some of the data suggests that they may not be able to do it this year if these inflation numbers still stay the same. So, but now what we're seeing is so bonds starting to pull back, and it's been a pretty decent retracement. Now we're all the way back to this next 382 retracement. Let's look at it on this different perspective. I want to grab it from a trending direction. So let's grab, there we go, like that. So now what we're looking at here is we're looking at the swing high point, the swing low point, the retracement, this direction. 50% retracement means we've come all the way back. We've retraced by half. Okay, if this is the low and this is the high, halfway back is a 50% retracement. That's a common retracement zone. We slid right through this 382. We haven't tested the 50% yet, so more than likely that's going to be our next test, is 9150 on bonds, which means interest rates still going higher. So interest rates have been moving higher again during this retracement. So whether or not we find some support or it dips down into this 50618 box, this is a pretty common retracement location. If bonds are going to hold up, they're going to have to do it soon, but they can dip all the way back down into this range still have it be considered a potential uptrend for more highs to come. I think the market's paying close attention to that, to what bonds are doing and interest rates, and the Federal Reserve. That's still going to be a talking point going forward. We're seeing, in terms of commodities, we're seeing not a whole lot of action taking place. Oil is trying to create a new uptrend. It's been bottoming out here now for the last couple months. December was the low, January working its way back up again. So as we're seeing a potential retracement in equities, we're starting to see support and a new uptrend in oil. Whatever that means, it doesn't necessarily mean a lot, other than it can be a headwind for the economy when companies just have to pay more for gas, and oil, really anything to do with petroleum-based products, become more expensive. And if we're trying to find ways to lower inflation, and we're trying to find ways to get things from increasing in price, then the Fed's not doing a very good job on oil, although that's not what they're focused on. I think we've got geopolitical risk in the Middle East, which is affecting oil prices more than anything else. Remember, when with commodities do nothing. They don't produce anything. They are just simply a commodity. So the only thing that can control a commodity price is supply and demand. So as you get supply and demand or perceived supply and demand imbalances, then you're going to see price activities moving in commodities versus a stock. When we're talking about stocks do something. Okay, as they're going higher, they are actually producing an increased value. You put $1 in one side of this company and $2 comes out the other side. It's increasing, it's growing, it's this moving, breathing thing that has an intrinsic value to it. And market participants are just trying to say, what is the current market value of the future earnings of this company? And so you get this, you get a marketplace, you get the battle, you get ebb and flow back and forth as market participants are trying to say, what the heck is this value? Is this company worth? Are they making money? Are they not making money? Are they increasing market share? Are they making new products? Are their products being bought? Is their pricing structure sound? All those different things come with a stock price versus a commodity. This is why I prefer trading stocks over anything else, is because there is an underlying mechanism, that is an underlying entity that has intrinsic value, and it's moving higher. And all we've got to do is be on the right side of that direction as it's moving higher. We don't have to know a whole lot about the stock or the company or the revenues, but we want to be in something that's growing aggressively. We want to be in something that's moving in an uptrend, that's got an opportunity for really big, nice growth. For the most part, at least that's the foundation methodology of TradersPro. There's lots of other ways to be able to supplement that and say, I'd rather own, Costco, or I'd rather own, and that's not necessarily a bad idea, but I'd rather own names that I recognize and in bigger, in large cap or in sectors that I'm familiar with. One of the ways to look for those is if you go to indexes, go to index scans, and then you can see some of these main indexes and see which ones to be considering. These are, for a momentum uptrending strategy, we're not interested in these. Okay, for maybe a potential contrarian reversal strategy where stocks have just gotten obliterated and they're moving to the downside and maybe finding some support, then we can consider those. But as of now, we want to focus on stocks that are in uptrends. So, when was the last time General Electric was talked about as a growth stock? This thing was just about dead and gone. And look at the stock. The stock has been doing really well, 75% over the last year, 15% over this last month. So there are opportunities in some of these big names. And these are some of the places to look for. IBM actually had a nice pattern, nice uptrend, big earnings, retracement. IBM could be kind of a stealth player in AI because of Watson and a lot of the data that they have. Watson is one of the original AI models that has been around a decade or so. And so IBM is going to be a player in that space. I think the market's kind of catching on to that. So IBM is just, coming back to life. So some of these names that we haven't considered, or at least, I haven't considered, thought about, or talked about, are continuing to do well. And they're just big name companies that you may be familiar with. If that's the approach that you want to be looking for, then you can also build out scans. Look at the market cap on this. So it's 500 billion in market cap. If I wanted to create a screen that is looking for some of these really large, cap companies, I could simply say, all I want are high ranked stocks that are, let's say, 90 or higher, that have a current buy signal and that have $1 billion in market cap or higher. And let's even put some price on that. They're going to be high price stocks anyway. Let's just put it on 10 and let's scan that and see what comes up. So 15 stocks, and these are going to be familiar: Meta, Nvidia, Eli Lilly, Uber, Palo Alto Networks, Applied Material, General Electric, Lam. These are the who's who of, global companies as well. So it's still possible to be able to build out a good momentum strategy with with massive companies. You know, Meta has been a good example because it just keeps cruising. It's not acting like a $1 trillion market cap. It's got a $1.2 trillion market cap. And for it to be moving the way that it's moving, 23 million shares a day, that's really impressive for a stock like Meta. And obviously we know the story behind Nvidia. A lot of stocks having some retracement right here. I think it's good. I think it's healthy. I don't necessarily mean that we're in for a major market collapse, but we are due for a retracement just like this. We need 5, 6, 8, 10%, potentially even in the market as a whole, at least 3, 4, 5% on the market as a whole, to remove any of the pent up potential fear, see it kind of wash out, see demand start to come back in, and ultimately I think that's going to be a good thing for the market. Now, in terms of managing risk at the portfolio level, when I say portfolio level, what I'm talking about is I'm talking about the entire pool of money. So let's say that I'm managing $100,000, but let's say that my asset, that I have $500,000 in total investable assets, but I've only decided that I'm going to trade equities with 100,000 of that, and I'm going to use this strategy with that money. Okay, I want to be able to manage this, whatever money I'm utilizing for my portfolio, separately than all of my assets together. If I'm using the wheel strategy, which is what this method is, it's essentially we're adding into new positions each day, and either selling or winners or getting stopped out of both winners and losers. It's this natural evolution of adding new stocks, having some of them work, some of them don't work. But one of the things that we can do, and that I've actually added in as of this last week, is adding a little bit more of a hedge to the cash position. So of this cash position, which again is still of my 100,000, that may or may not be all of my assets. That may, my point in saying that is I may be in retirement, and I may be in a scenario where I still want to try and get some, some growth, but I also will need to preserve my capital, and I don't want to be taking too much risk. Well, maybe that 10,000 of my 50 is what I'm using. The other 40,000 is going to stay in cash. So of this cash amount of my allocated percentage that is going to this strategy, I still may have cash. And I want to treat this hedge as a cash position, meaning I may treat it slightly different in terms of stop losses, in terms of targets. It's just simply a way to be able to say, if the triple Qs, which is the NASDAQ 100, drops, so let's go to this, if that drops, come on, okay, over the 1 year time frame, if the Qs starts to pull back, then we are in a position, if it goes down by 1% for that piece of our cash, which is, again, it's just a hedge, it's just security against downturn, then that is going to increase by 3%. It's an inverse and leveraged ETF. So if the markets go down by 1%, SQs, or I should say, if the triple Qs goes down by 1%, that will go up by 3%. And we can use that as a hedging position in our portfolio. So that's one of the things I've added in here this week, is a little bit more of a hedge, and continuing to look for opportunities to get rid of losers and hold on to the best stocks that are working and tighten the stop losses on those. So really that's my approach right now in these market conditions, is also considering a little bit smaller position. TCRX, this is a new position that we just added, and notice it's at 2% instead of 2.5%. Maybe it's a little harder to see right there, but it says portfolio allocation 2%. So we can also lower the percentage allocation that we're increasing into our overall perspective, because what we want to start to do is we have to take it day by day. We've got to analyze the market for what it's giving us. And what it's giving us right now, and where it's been, and where we could anticipate that it's going. We want to continue to participate in new stocks, but we also want to be aware that things can turn, and they could turn quickly. And this feeling of pent up lack of selling, that can switch so fast. And so the only real ways to adjust that are, number one, your time frame. You could say, okay, I'm in it for the long haul. I own General Electric, but I'm fine owning it for 5 years. That's a different game. That's a different methodology than we're utilizing. You've got to be able to utilize a little bit different approach to that, unless you are using TradersPro still and saying, General Electric, I'm going to trade it as long as it's moving higher. As long as it moves lower, I'm going to be out of it. So it could be a short-term perspective that turns into a longer one if it continues that overall uptrend. But if you're looking for something longer term and just holding on and don't care what this does and don't care if it retraces or moves lower, then that's one approach. That's not our approach. We want to get out. Why hold on to something that's losing? Why hold on to something that's dropping in anticipation of hoping at some point it might go higher? Well, let's just focus on what is going higher, and there's lots of things to focus on there first and foremost. So we're focusing on the risk by position size, by stop losses, and by hedges and cash. So those combinations. If you're a little bit more advanced trader, a little bit more aggressive and advanced, you can apply some option strategies as well. If you wanted to be able to say, I'm gonna, maybe I buy put options on the Qs or on some of the stocks that we have in the holdings. There are additional ways to be able to protect against downside that you may be able to implement. For the most part, we're not using those. In fact, I'm not using them at all in this method. We're simply using position size, stop loss, cash, and hedges to be able to manage, and that's enough. That's enough, especially when we end up managing about 20 to 25, maybe 30 holdings at one time. I think we're at 22 right now. That tends to be about the average. Sometimes we'll get a little bit more than that. I don't like to manage too many more than that as well. We could, a lot of times we've got this cash position that on the net, if we get a retracement down and another new opportunity for more upside after a decent pullback, then we can utilize more cash by using a little bit bigger position, a bigger allocation. If we're at 2 and 2.5% right here, 2.5, then we can bump that up to maybe go 3 to 3.5%, maybe even more, maybe even 5%. We're doing so these pie slices just get a little bit bigger, and we're gonna be a little more fully allocated across the entire portfolio, but we've got bigger pieces of the pie now. That adds more volatility, that adds more potential risk to the downside, but in return, it adds more potential upside as well. If we've got a bigger position, 5% instead of 2.5%, and that goes up by 100%, 70%, 70, 80%, we're gonna make more money. But we're at the point in the market where we could get some volatility, some retracement. I don't want to do that yet. And in fact, I'm going the other direction right here, down to 2% on some of these holdings, and going to start to whittle away some of the losers. I'd like to get maybe down to 15 holdings here, especially with the market. I think that we could get a retracement and another push higher in the market, just based on the way that pattern looks. If we look at S&P 500, and I don't know why I always do this, but I end up getting distracted and clicking around here for a minute. But this pullback, if we get some retracement and some support right around these levels, either here or here, and find some support, there is a possibility for one more push higher, really get that blow off top. That'll be a good opportunity to close out some winners, close out some losers, set up some additional hedges for some downturn. That on the flip side, that could be beginning now with some of these moves, but it's not. I say it doesn't look like it yet, but that can always change. As of right now, there is a lot of support. There's no fear based on that sentiment indicator quite yet, and the news items, earnings are good. Economic numbers are relatively stable for the most part. It's just dealing with interest rates right now. If the Fed, in fact, economic numbers and things have been actually quite good. And that's part of the problem is the Fed needs them not to look so good in order to lower interest rates. The other side of that is things get bad. And if things get really bad and the economy starts to suffer, well, the Fed is going to be forced to lower interest rates. So I think I mentioned this in one of the last updates that um, Powell, I almost said Bernanke, Powell was saying that in this interview that I saw that interest rates, as long as interest rates are high and the economy does slow down and get worse, then that gives them more ammunition. If they start lowering interest rates and we get a recession and they have nowhere to move, they can't lower rates any lower, that puts the Fed in a tough bind. So I think right now they're hedging against a recession as well by keeping rates high enough that gives them enough room to lower them if they need to. That's a lot of hoeing and humming. It's a lot of conjecture, which I don't like, but at least it's the talking point of what is happening in the market and the economy right now. We need to be aware of some of those discussions. Being aware doesn't necessarily mean it makes any difference, but the market is paying attention to that, so we need to be paying attention to what the market's paying attention to. So S&P 500, seeing a little bit of a pullback here and a retracement right now as things stand. So that's kind of where we stand right now. Some stocks, in the new buy list to consider. TCRX, this actually was our new buy today in the portfolio, so we're up 11% on that. We've had some volatility, had a couple of others that stopped out. And that's just the nature of portfolio management and stock trading. Is some are going to work, some are not, some are going to be exciting to the upside, some are going to be stressful to the downside. We just need to make sure we're managing those risks so that it's not no one holding could really make a huge difference, could really, really do amazing in one day or two or three. Obviously, over time, they can really do great. But what we want to worry about more is the downside risk of what one day can do. For example, this stock, this is, let me pull back here. This was this morning. Let me see if I can pull up this symbol, GCT. So GCT, I still haven't had a chance to look to see what the issue was or the news item, but it halted this morning. So this is one of our holdings. We had a stop loss on it. The stop loss was at 24.50. We hadn't adjusted it quite yet, but it moved all the way lower and it halted the stock, and then it continued and we were stopped out. We had a gain on it. It was a small gain, but we had a nice gain happening here. So this is the risk. This can happen at any time on any stock. And there's a lot of these stocks that are aggressive and that they're moving quickly they can have a day or two of, all it takes is one thing to happen where the air gets let out of some of these stocks and they can get blown up. So 25% to the downside means about 0.3 of 1%. For volatility. So that's about $300, $400. This ended up being, from this high to this low, ended up being a little bit larger than that, but it was frustrating. It's painful, but it wasn't that painful. This was not oh my gosh, I'm going to have to start saving again for the next 10 years. If that's the case, and if you're ever in a position that's that big and you're thinking so hard about it that you're thinking about it, it's too big of a position. Make sure these positions are small enough and that stop loss is always set up so that if it does have a crazy move for whatever reason, you're able to make an adjustment. Some nice looking stocks in here. CBOE, I saw this one in here yesterday. And brokerages and exchanges, lots of uptrending stocks, lots of good things to look at. So really, even if market conditions pull back, I think they're going to be, there's going to be lots of stocks. It's a stock picking environment. It's going to become even more so stock picking environment. And as the market, some of these stocks that have had these huge moves start to retrace or pull back or correct entirely, and there's going to be some of these others that starts to pull the market down as a whole. There'll be opportunities. There's always an opportunity, and we've got to continue to be in there, got to continue to play, got to continue to look for those opportunities, and and focus on the scans and then focus on our risk and our money management. So I hope you find value in today's session. I appreciate everyone for your time and effort, and I'm going to end on that note. Have a fantastic day today. Bye now.